We are living in unprecedented times. The precious metals complex is trading still, despite the correction, at very, very high levels. And the US debt just reached $38 trillion. What do we make of this? It is a fascinating time, and as you can tell, I'm back in Frankfurt. I'm back in the studio, and I'm really excited to have my usual setup here, but I'm also really excited to introduce you to my next guest. His name is Mark Thornton. He's a senior fellow at the Mises Institute, and as you can tell, we will talk about the Austrian Economics, or the School of Austrian Economics, and how we apply it to today. Like, what can we learn from it, and what should we be paying attention to moving forward? Really interesting discussion that we have lined up. I'm really looking forward to this. But before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously, and we much appreciate it. Thank you so much for doing that. Now, Mark, it is great to welcome you on the program. I'm excited to have you on. Thank you so much for joining us.
Oh, thank you, Kai. It's great to be here with you today.
Yeah, really looking forward to this. As I mentioned to you before hitting the record button, I think you're the first guest that we had on, or that we have on from the Mises Institute. And we often use the term Austrian Economics here on this program, but I don't think we've ever explained what it means. So I'd love to start off this discussion, Mark, real quick. Can you give us a 30, 60, maybe 90-second overview? What is the Austrian School of Economics?
Sure. The Austrian school goes back into Europe, into Austria, in the 19th century, founded by Karl Menger. And then, many students developed in Europe, including Ludwig von Mises. And he fled Europe during World War II and brought Austrian economics to the United States, along with his student Friedrich von Hayek, who won the Nobel Prize, and Murray Rothbard, a Native American. And the Austrian school really is a theoretical school. The Austrians invented, the concepts of opportunity cost, comparative advantage, all the things you learn in the first few chapters of a college course, and really supply and demand as applied to marginal economics. So we're all about economic theory and less about, charts and numbers, computer programs, data sets, that kind of thing. So we bring a fundamental analysis to the economy and to markets and to economic situations. And so that's really the important point. Is it's a theoretical approach, deductive approach based on logic, reason, and human action.
Really appreciate that, Mark, because I don't think we ever explained what it really means here on this program. Of course, a lot of our viewers know that, but I figured let's fill in the other half that might not be as familiar with that term. But Mark, you mentioned something interesting, like the economic situation. Help us interpret it a little bit from your point of view. Like, where are we at right now? How would you describe it?
Well, in terms of the economy, I'm very, very concerned with the world economy. Because of the direction that governments have taken us. They're spending out of control. They're all borrowing huge amounts of money, and they're all printing up massive quantities of the fiat currencies. And so, the U.S. dollar is down relative to some of the other currencies, but generally the trend of all fiat currencies right now is down and down precipitously in terms of their purchasing power. And certainly, if you want to measure it versus the price of gold, the price of silver, and so forth, it's obviously that our money is able to purchase less and less. And in the United States, in my home economy, and in many economies around the world, you have a huge percentage of the population where their real income, when it's adjusted by prices, is actually falling so that they can buy less and less over time. And that's a very dangerous situation because at the same time, the governments are making the economies less competitive and less productive. And the trade war on top of that is the thing that's the scariest of all, because I know, it comes and goes and President Trump does this and that, but we're still moving forward with a world trade war, and this has military implications, and we have military hotspots around the world. And so this is all very, very concerning to me as an economist, because, of course, war is the worst thing that the government can do. But inflation is also terrible, and so is these massive government debts. And politicians around the world, whether it's the United States, Canada, Europe, the European economies, Japan, and even China and many other countries, they're running up huge debts. And you know, even if they're not printing up money now, they're going to have to print up more money in the future to pay for all this. And so the fundamental status of the economy is that it's weakening worldwide in things like the military situation, the trade war, the budgets, and the money printing are all massive concern to me.
Yeah, reminds me sort of what the Austrian School of Economics has been warning about all along is exactly what is happening right now. Would you underwrite that as like this is the end game based in your economic theory here? Is that what we've been fearing all along?
Yeah, I mean, it certainly is. And of course, an inevitable consequence of all this is that politicians want to push for more government intervention in the economy. They see all of the micro problems emerging because of the macro problems that they're causing. And so their first instinct is to enact even more government intervention. And I think that's where President Trump's trade war is coming, which of course invokes retaliation from other countries. But they're, in the process of, making it more difficult for families to earn their way. They're making it more difficult for companies to be productive and to employ workers. They're absorbing capital throughout the economy so that we're putting more of our real assets into the government instead of into the productive economy where it needs to be to employ people and to buy capital in order to raise people's wages. And so they're doing exactly the wrong things, moving ever closer to socialism rather than to a free market prosperity.
Yeah, it is interesting. We're seeing that currently on the critical minerals side, but also on the AI chip side, where the U.S. has taken a stake in Intel. We're seeing it now on the critical minerals side, where the U.S. has invested in MP Materials and many other companies as well. Trilogy Metals comes to mind in Alaska. So you're saying like this is a step in the wrong direction. The government may be overstepping its powers here or overusing its powers?
There's ways that the United States can increase its production of anything, including rare earth and critical metals and so on and so forth. But the government coming in and buying stakes and providing subsidies and granting massive loans is obviously the wrong thing. And you have President Trump himself and President Trump's supporters and admirers who were very critical of President Obama making those same subsidies and investments in solar energy and other, crackpot ideas. They were all critical back then of President Obama's choice of favorites, but now they're seemingly saying, well, this is the way to salvation when it's the exact same stupid policy. And so, if we peel back, a slight veneer, we realize that that it's the wrong way to go. I mean, that all of President Obama's subsidies and bailouts and massive loan guarantees to his favorite firms, they all failed. And we're going to find out, that the investments in Intel and rare earths and tungsten and all that kind of stuff, it has a short-term blip where you seem to get, that's getting some action. But down the road, you're going to find, a crony capitalist company that's underproductive and living off the taxpayer, really.
Before we come to the micro, and I do want to discuss with you gold and silver because I know you've produced videos on that topic as well. I want to stay on the macro for just a bit longer. In my intro, I mentioned the crippling U.S. debt situation, over $38 trillion. The last trillion was the fastest added ever. How does that sort of fit in? Like, what is the end game here based on the Austrian framework? Like, what are we looking at? What can we anticipate?
Well, I mean, there's many different aspects. When you've got $38 trillion, there's lots of negative effects. And it means we've put $38 trillion of real resources into the government, which is not productive, it's not efficient, it's not producing goods and services. It's money that politicians have borrowed and they've spent it. And we don't have anything to show for all of that money, but the debt itself. And so now we're seeing the chickens come home to roost on that massive debt because the financing costs, the amount of money that Americans have to pay, the American government has to pay to finance that $38 trillion is rising. It has risen. It's going to continue to rise, and it's over like $1 trillion a year right now. And I think it's the largest single item in the government budget, or at least one of the top items in the government budget. So that's an expense that's going to, even if everything stayed the same, it's going to, that's a perpetual expense basically. And of course, it's scheduled to rise. And when interest rates go higher because of the inflation factor in interest rates, I think, the Fed's going to cut rates in the short term. But in the longer term, it's going to force interest rates higher. And so that debt servicing cost is probably going to grow. And that's really the thing that I worry about because, they can't really tax the economy anymore. We're at the limit as far as taxation is concerned. The borrowing costs are crippling the private sector. So the only thing they really have to turn to at this point, and a lot of experts in this area are anticipating them relying increasingly heavily on simply printing the money, rolling over the debt so the government will borrow the money and then the Fed will buy the debt from the marketplace, but they'll have to print up money in order to buy that. And, we already experienced that during COVID where the Fed bought up all the debt that the government was incurring in the short run, and everybody said, well, it seems to be okay. But then, of course, a year, 2, 3 years later, we were experiencing 9% inflation. So that's what we have to look forward to.
Inflation is an interesting topic, Mark, because it is Fed week, so I almost forgot that in the intro, but it is Fed week, although it almost seems like a nothing burger this week. It doesn't really seem to be making headlines. At least I'm not hearing that much, but the inflation topic is an interesting one because that's sort of the only data we got last week. We didn't get any unemployment data, but the Fed is putting heavy weighting on the unemployment trend that we're seeing right now, and the employment data in general. Do you think they're making a mistake? Are they focusing on the wrong end here, meaning the unemployment data versus inflation?
I think the Fed is almost always making a mistake. And I should say that when Austrians, I should qualify my statements that we think that inflation is when the Fed is printing up money and injecting it into the economy. Of course, most people speak of inflation in terms of the effect of that policy, which is rising prices. And there is a disconnect between the two in the short run. They have to issue the money, it has to circulate in the economy, and then prices rise. So the government gets to buy things before the prices go up. The government contractors get the money, the banks and the speculators on Wall Street, they all get the money first, and then prices rise, and then you and I get the money, but we have to pay the higher prices. And so that's an important distinction that Austrians do make. And, the Fed no longer believes that they are responsible for the higher prices. They ignore and deny the fact that increased money supply increases prices. So they're in a total disconnect, and that's why they make mistakes in terms of policy and timing. And frankly, right now they've always been telling us, going back in time, that they're data dependent. And now that the data is not there, well, they're just proceeding along their traditional playbook. And their playbook only has one play, that's printing money. And they see political problems for themselves. They see problems in banking specifically. They see problems in the economy, and they see a stock market that's probably weakening. It's kind of leveling off, and so they're jumping and using their number one play, their number one tool, their only tool, which is to print money, which means they're going to cut interest rates and inject money into the banking system.
Mark, like it's always interesting. Like I like talking theory, and it's popular, of course, to bash the Fed. But what should they be doing? Or maybe let's roll or approach it from a different. Is the Fed even relevant these days? And how would you substitute it? And see, maybe if we agree that they might be relevant to a certain degree, what should they be doing?
Well, I think it is relevant in the sense that what they do does matter. They're the ones that are responsible for creating higher prices in the economy. They're the ones that are responsible for destabilizing the economy by creating business cycles. Okay, so they reduce interest rates. They engineer investment demand on Wall Street. They drive up asset prices. They create booms. But of course, as that money circulates, and as prices rise, those booming investments sour out eventually down the line. And it can take a long time, depending on how much money they're willing to inject. And they're also responsible for distorting the distribution of income. So when they're in an active phase, they're benefiting stock owners, asset owners, bankers, the government, and politicians. But simultaneously, they're undermining the American family. They're undermining real wage rates in the economy. They're undermining productive investment and capital in the firms that actually produce things, provide services that increase the economy's productivity. Everybody knows that small companies that are making investments that are, creating efficiencies and productivity, that those are really the source of new jobs and higher wages in the economy. And when the Fed is printing up money and sending it to Wall Street and sending it to Washington, D.C., that means there's not money going to those small companies that we haven't even heard of yet. But that's really the source of growth and strength and prosperity in the economy. And the Fed can get away with that because, nobody knows about Corporation XYZ or Bob and Ted's magical company out there that's going to be, the next big company on the horizon that's going to produce the next great product that's going to, create the next great technology that's going to make us more efficient and that sort of thing. So they can get away with, with the price inflation distortions and the business cycle and also this maldistribution of income that they cause that makes the rich richer, the people who already have money and can leverage up, they get richer. But the working class in America who sees their real wages undermined and the companies that they work for unable to grow and expand and become more productive and more efficient, those are all the people that are getting hurt. And those are the people that are suffering right now.
Oh, and they are based on the unemployment data and the other data that we're seeing. It is not looking great. Credit card delinquencies, car loan delinquencies are all increasing as well. It's not looking pretty out there. Let's be honest. But let's try to put that into context with the rising gold price as well. And I'm wondering, Mark, maybe on a very high level at first, but what is gold and silver to a degree telling you here as we actually dive below 4,000 as we speak here, Mark?
Gold and silver, excuse me, are real money. That's what the market chose as money thousands of years ago. The government has intervened in money slowly. It took them about 100 years to go from gold and silver, a 100-year transition to where they could just print up pieces of paper. But they did it. They got away with it. They're getting away with it. But they can't completely hide what they're up to because gold and silver prices are reacting to this runaway spending, inflation, and borrowing. And and so we've already seen a big increase in gold prices from like 1,000 to over 4,000, and silver prices from around $10 on up to $50. And so this runaway government is showing up in the markets for precious metals. I'm not very surprised at that whatsoever, and I think that's going to continue. I know that we're going through a painful pullback right now, but if you look back in the charts, you'll see that there's been, a many 100% increase in the price of both of those metals since they bottomed out a number of years ago. And, there's nothing really to suggest that that's going to stop or reverse itself in any kind of major way. I mean, right now, this is really being led by other central banks themselves. So the dollar is the world dominant currency, but other central banks no longer trust the dollar. So it's hard to believe that individuals could trust the dollar as a store of value. Of course, we have to use it as a medium of exchange. That's still relevant, but as far as being a store of value, even other central banks no longer trust the dollar, and an increasing number of individuals and companies are turning away from that. That's really what the whole BRICS currency alternative is about, where you have, Brazil, Russia, India, China, South Africa, and other countries wanting to get away from the dollar, the monopoly dollar, and have some alternative that's more stable and less subject to U.S. control.
I was going to say, the dollar's been declining since the 70s, since Nixon took us off the gold standard, or took the U.S. off the gold standard. Why is it now so pertinent to leave the dollar system? And it seems to be there was a rethink that was going on, and I'm struggling a little bit that it's just the loss of value of the U.S. dollar as a currency. I think there's more at play, and you sort of hinted at it with sort of your last remark here. There's geopolitics at play as well. So I'm trying to understand and put maybe the rise of the gold price in context. How much does it have to do with the loss of value in the currency versus just geopolitical turmoil on the other end?
Well, there's so many factors. I mean, that's the thing about gold and silver as money, is that everything affects them. And I showed recently, if we did have a free market world economy, that those two things would be almost perfectly stable. But in the world where you have a highly interventionist economy and competing countries where the U.S. is no longer the sole dominating factor in the world, you have China, which has risen to an economic superpower, and it wants to have a say-so with respect to money. And so it's organized the BRIC countries. And so it's actively trying to take its role as a world-dominating currency. And then, of course, you have the situation in Russia, where President Biden essentially took away Russia's foreign exchange money and its ownership of U.S. government debt. The Europeans did the same thing. So the Russian, not only are the Russians no longer trusting the United States and the euro with respect to this paper system, but all central banks are now worried that if the U.S. can do this to one country, if the European Union, the European Central Bank can do this to one country, and you've got runaway government where politicians think that they can do anything they want, then why not, the U.S. and the Europeans do the same thing to other countries who don't please them or don't obey them? And so, yes, those geopolitical factors do matter in currency and debt, as well as in this trade war. And so, the trade war is obviously directly linked to this international conflict, because Russia's right in the middle of it, and Russia's friends. India has gotten dragged into this. China's gotten dragged into this. And who's to say the next country that doesn't get dragged into this conflict because of some other connections, economic, political, or military, that they have with some unfavored government actor in the economy. Now, that doesn't mean I agree with everything the Russians or the Indians or the Chinese do. It's just that this is conflict between politicians that could drastically negatively affect your economy, my economy, and our listeners' economy out there in a major way.
Yeah. Well, Germany's economy is already down the drain, so that ship has sailed for us. But maybe just coming back to the currency, I have one last follow-up question before I want to end with some more questions on gold here. But China is pushing more countries and more trading partners to transact into yuan. Is the Chinese economy or is the Chinese financial system strong enough to demand that already? Are we at a turning point here where China is starting to make inroads? BHP was an example where 30% of their iron ore trade has to be settled in yuan. As a signal, perhaps, is the Chinese financial system strong enough to handle that already, or is there just a blip?
Well, it's not a blimp. And, as I mentioned before, it took 100 years for the U.S. to become an economic superpower. It also took 100 years for us to turn the gold standard system into a pure paper system. So these things take time. I mean, for sure. But China's been working on this for quite a while, and a lot of its strategic economic measures in terms of refining gold and refining silver, refining rare earths. This is all part of it. President Trump didn't realize when he started this trade war is that he was not holding all of the economic cards, that China was actually holding many more cards than anybody thought. And so they've been working on this for quite some time. And, the BRICS currency union that they're developing is developing very rapidly. And the moves that the United States has been making are really, as I see it, they tend to be falling directly into the hands of the Chinese. And so what we've been doing, what President Trump has been doing is, unfortunately, it has the effect of actually strengthening China's hands, and they're developing, a trading system, a currency trading system, a gold trading system around the world, and the fact that Western markets for gold and silver really clammed up recently. I mean, that's part of the whole downdraft in the metals market is that we couldn't handle the expansion in this marketplace that you and I have been looking at for a couple of years, and these London and Chicago and all these marketplaces didn't really measure up to that expansion in business. But China is working on expanding all of those businesses. So the trend is in China's favor as I see it, and it's going to take some time. I don't see, the dollar disappearing and the Chinese yuan magically dominating the globe in the next couple of years, but that's the direction.
No, I appreciate that. I really appreciate your remarks on that topic, Markus. I think it is an important trend that is accelerating. Maybe last 90 seconds here, Mark, on gold and silver. As we were speaking, gold is below 4,000 and silver is way below $50 again. I read $46.50 as we speak. What should investors do right now?
Well, I'm not a financial analyst, but I see this as a very long-term trend that has positive implications for gold and silver. If the governments magically, or if they tried to fake us into thinking that they weren't going to spend more, borrow more, and print more, we don't see any signs on the horizon that that's going to take place. They haven't made a dent in the U.S. in terms of government spending, President Trump is, attacking the Federal Reserve for not reducing interest rates and printing more. He's appointing people who advocate for more printing. He's been beating up Jerome Powell, who had been, towing a tough line on monetary policy, and now Powell has caved in concessions to cut interest rates going forward, which means more printing. So I would view, there's been a tremendous rise in both metals, and the painful adjustment downdraft that we are experiencing currently is, it's relatively small compared to the big up move. And I think some of this is obviously profit taking and short-term investors running for cover, but it's also the fact that this market is expanding, and instead of just silver stackers and central bankers who are long-term holders, we've got a lot more traders and speculators and day traders and machine buying and all that have entered the marketplace. And we've seen a lot of disruption in the formal markets in London and in the United States. We're seeing refineries all backed up. We're seeing the spot price rise above the future price. So this is an abnormal situation right now.
No, fantastic.
Although a cutback in price is fairly normal.
Yeah, I think we're overextended over the 200 moving day average by over 30%, I believe. So it is normal to see that setback. So personally, I'm not too worried. Of course, it is sad to see $4,000 losing the four handle on the gold price here. But hey, as you said, the trend is intact. So I'm not too worried. I think we can all see where this is headed long term. And really appreciate your insights, Mark. Really appreciate you joining us here on Soar Financially. Where can we send our audience to follow more of your work, Mark?
Well, Mises Institute, mises.org. It's one of the largest economic web pages in the world, one of the most trafficked web pages, and you can read everything that we do. We have like 5 different podcasts, and right now we're offering a free copy of Friedrich Hayek's, the greatest hits of his articles, which contains, his article where he suggested the idea of Bitcoin. He was the major inflation fighter during the 1970s. He wrote about how the worst get to the top. So if you want a copy of this free book from the Institute, just put a comment on this podcast episode that I want Friedrich Hayek's greatest hits, and I'll send you the link to it.
Perfect. Awesome. Yeah, just put hashtag Hayek or something down below so it's easier to track. And really appreciate that offer, Mark. Much appreciate that. It was a great pleasure having you on the program. Next time we'll need to schedule like 3 hours just to get through it all. Really, there's so many things that just you mentioning, just bringing up Bitcoin, like how does that work in the world where gold and everybody is buying gold and silver right now to protect, and just the theory behind it would be really interesting to discuss. We haven't even talked CBDCs, so we'll need to do a part 2 here, Mark, very soon. So really appreciate your time. Thanks so much for coming on, and everybody else, thank you so much for watching. If you enjoyed this conversation, don't just put hashtag Hayek down below, but also leave a like, and if you haven't done so, subscribe to the channel as well, and just leave general comments down below as well. What do you think of the conversation, and how are you applying the School of the Austrian Economics to your daily life as well? I'm really curious how that works out and what your thoughts are in that regard. Thank you so much for tuning in. We'll be back. Take care out there.